equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Rice. I am excited to do another Learn to Invest off in 15 minutes or less.
So last one we did was on the correction, the market correction. This episode, we are going to address the terms bull and bear market. We're going to go back to a bit of a pardon the jargon, which was an episode we did a while ago. We looked at a few common terms that are linked or that are used in the investing world, and the bear and bull market are two terms that you'll probably regularly hear in relation to markets. So what are they? What's a bear market? What's a bull market? Ren, do you have a definition for a bear and or bull market?
Yeah, so I mean, let's just start really high level. You'll hear people use the terms bull and bear market a lot
Yes.
in investing, and no, it's not the market for livestock futures. It is just shorthand for, I guess, explaining which way the economy is trending.
Yep.
So a bull market is shorthand for when the economy is trending upwards, and then a bear market is shorthand for when the economy is trending downwards. So and I think you have some more specific actual, I guess, like criteria
Definition?
for each
Yeah.
of them. Yeah.
Yeah, well, particularly bear markets. We spoke about in the last episode the correction, and it was signified by a 10% drop in the market. Now, that has to occur within a 2-month period of time for it to be classified as a correction. Now, if over more than a period of 2 months, the market has a downward trend, then it technically becomes what is known as the bear market. So that downward trend on price makes it, over 2 months, makes it become a bear market. And the same would be for a bull market. I guess for it to come out of that bear market, it needs to have a sustained increase over a period of more than 2 months, and then it would be classified as a bull market. So it would be safe to say that we are currently in a bull market, even though we had the 10% correction in February.
To be clear, it does. There's no threshold. It can rise by 1% each month, and that will still be a bull market.
That is my understanding.
Yeah. Okay.
Yeah.
I think that's where we're gonna end up with this discussion. Is that a lot of this terminology is pretty loose. Investors sort of know what it means, but in terms of trying to carefully define it, it's a little bit. Well, it's just not very well defined, I guess. So
No.
as long as you understand what the general terms mean,
Yeah.
then that's the main thing.
What they mean, and then also what it reflects. And
And what you should do.
Yes.
So, speaking of undefined and unclear,
Yes.
we both have differing ideas of where the terms came from.
Yes. Well, I've got two, so I'll start with one.
Okay.
Then you come in, and then I'll finish with the big clincher.
You know it's uncertain when you're hedging with two answers to the question.
Yes. So where does the term come from? That's the question that we're going to try and answer. Firstly, the bear and bull markets are named after the way in which each animal attacks its victims. Interesting. It's characteristic of the bull to drive its horns up into the air, while a bear, on the other hand, like the market that bears its name, will swipe its paws downward upon its unfortunate prey. Furthermore, bears and bulls were literally once fierce opponents, where it was popular to put bulls and bears into the arena to fight. So that's one reason that the term bull and bear came to be.
Interesting. I didn't know that bulls and bears fought.
It was in the Elizabethan era, apparently.
Wow. There you go.
How epic would that be?
Yeah. So my answer is a lot less interesting than that.
Okay.
I thought that the terms came from the economist John Maynard Keynes. He wrote a book in the 30s about finance and economics, and he spoke about the animal spirits that animate the market. And he basically talked about, how humans are not always rational creatures, or not perfectly rational, and so their decisions are based are influenced by their psychology. How optimistic optimistic they are or how pessimistic they are about the market. And he talked about these, I guess the psychology, the influence of psychology on the market in terms of animal spirits. So that's where I thought it came from. But to be honest, I have heard of the bull attacks upwards and the bear attack downward analogy, I guess, as well.
Okay, so you've gone with a bit more of a technical, I guess.
Yeah, boring, you could
technical
say.
Definition.
But I believe that your last one is neither technical nor boring at all.
The real truth, the source of this is the real stuff. So historically, the middlemen who were involved in the sale of bear skins would sell the skins that they had not yet received, and as such, these middlemen were the first short sellers. So after promising their customers to deliver the paid-for bear skins, these middlemen would hope that the near-future purchase price of the skins from the trappers would decrease from the current market price. If the decrease occurred, the middlemen would make a personal profit from the spread between the price of which they had sold the skins and the price at which they later bought the skins from the trappers. So these middlemen became known as bears, short for bearskin jobbers, and the term stuck because it describes a person who expects or hopes for a decrease in the market. So I guess that's me. I'm hoping for a decrease in the market.
Yeah. And you've just given a good explanation of short selling as well, which I guess we can say is our third pardon the jargon for today.
True. Short selling.
So just to wrap that up very quickly, if you're short selling, you basically sell something to someone. So I sell a pen to you, but I don't actually own the pen yet, and I'm betting that the price of pens goes down. So I've already got the money from you, and then a month later I have to deliver the pen. So then I go and buy the pen a month later. If the price of the pen has gone down, whatever the difference is, I've made that as a profit. If the price of the pen goes up, then I still have to buy the pen and give it to you, and whatever the price of the pen, however much it went up, is my loss.
Yeah. So it's quite an advanced trading technique, I would suggest, but definitely worth reading a bit further into, especially when you're looking at things like corrections and bear markets.
Yeah, but I wouldn't recommend trying to short sell bear skins because I think their usefulness is pretty long gone. Yeah. So I guess that's basic. That's the general gist of what they are. However they came about, they're now used all over the world. Bull markets are when the market is trending upwards. Bear markets are when the market is trending downwards. So now that you understand that, why should you care, I guess is the next question.
That is a good question, Ren. And just before we go into that, it's worth noting that a bear and bull market doesn't specifically relate to stocks only. It's very common for the term to be, as you said right at the start, applied across the economy in many forms: property, commodities, the price of milk, etc.
So you could say that the Australian housing market is in a never-ending bull market.
It seems like it. Or the Australian economy is in a never-ending bull market. That's a stretch.
Bad.
All right, Ren. So yeah, what does it mean, and what do we do about it? So we're in a bull market at the moment. What do we do?
So I guess the main thing to understand is that like everything in life, the market moves in cycles. So you will have a bull market, and then you'll have a top of the bull market, and then you'll have a bear market, and then you'll have a bottom, and then you'll have a bull market, and it will continue to move in that cycle. And the reason that it moves in that cycle is because people aren't perfectly rational. So when prices are going up, they continue to bid them up above what is intrinsic or fair value, and then people realize that they've bid it up too high, and so they overcorrect the other way, and that is just the natural cycle of the market. So whether you're in, and you might disagree with this, but whether you're in a bull or a bear market, I think the most important thing is to constantly keep putting money into the market, because over the long term, regardless of when you get in the market, what stage of the cycle you get in, the earlier you get in, the better. So I think that should be rule number one, that you make money from time in the market, not timing the market. And so wherever you are in the cycle, you should keep that in the back of your mind. That being said though, I think rule number two is, as the bull market gets more and more mature, so we're in year 10 of this bull market since the 2008 GFC. There's been a minor correction in 2015 and a correction in the start of 2018, but nothing major, and no stopping this bull market. So as we get more and more into the bull market, start to just hold some more cash on the side. Because what you want to do is, when we enter the bear phase of the market and prices get lower, then you want to deploy a lot of that cash into things that are a little bit cheaper.
Yeah. The further the bull market tends to run, the less risk averse people become. And it's a time, as Buffett says, when people are greedy, you should be wary. And so, as you said, Ren, this is the 10th year now, and having a bit of cash on the side is not going to be the worst option because who knows what's around the corner. So if a bull market continues going down, are you going to be deploying all your cash?
If the bull market continues,
a bear market?
It depends how it happens. If it just starts to trend down a little bit, I probably won't throw it in all at once. But if we have another GFC-like event, then I'll probably look to throw a lot of it in. The funny thing is, I was thinking about it. I only got interested in investing post the GFC.
Yeah.
I mean, it was really...
You've only ever known a bull market.
Yeah, and I mean, it was only really 2012, I guess, 2013. So I literally, I wasn't even close enough to the GFC to know what it was like to be in markets at that time. Like, obviously, I heard about it and I read the news and heard about the American housing crisis and stuff like that and, the AIG and stuff collapsing. But in terms of investing in anything other than a crazy bull market, I'm yet to see it. So who knows what I'll be like when one of them comes around.
Might just flip it.
Maybe I'll just be a complete mess. maybe I'll quit.
Crawl up in a ball. Well, one question that I want to answer for our listeners as well is, if you're in a bull market, you know that it's going up. It's been going up for years now, so it's a great opportunity to get some returns. What are some things that you can buy that, if you don't really know individual stocks and that sort of stuff, like, is there anything you can buy to take advantage of this bull market and get some return for your money, or do you have to buy individual stocks?
You never have to buy individual stocks. There's index funds, there's bonds, there's real estate or real estate investment trusts where you can buy shares of real estate. There's plenty of things. I feel like you're guiding towards a specific answer though. So why don't I let you answer your own question?
Well, I was just interested to see what you would say, but I guess from my point of view, the easiest way to make sure that you're in on the party, I guess, is just to buy in on index funds, exchange traded funds that literally follow the index. It's probably one of the easiest ways that you can get access to a bull market without having to worry too much about picking the right stocks, which still might have a bit of volatility. I don't know if you disagree with that, Ren, but...
Yeah, I agree. I think, what's the saying? A rising tide raises all boats, or... there's some...
Did you make that up?
There's some saying like that. Someone will know it. At least one listener will know what I'm talking about. And I think that applies here, that if you're in a pretty frantic bull market like we are now, if you're in individual stocks, you will see the benefit of just the general market rising, because prices basically across all asset classes, or across all stocks at least, get bid up pretty frantically.
Yeah.
But yeah, look, you're right. If you just want a broad exposure to the share market as a whole, so you can capitalize on the bull market, then just run-of-the-mill low-cost index fund is a good way to go. But yeah, as I said, I think the more mature the bull market, the more cash you should be leaving to the side. So, maybe
Agreed.
Rather than being, putting every paycheck, you might take a certain portion rather than investing all 100% of that portion in the market. Maybe you only invest 75% of that portion and you keep the other 25% just in case.
That's probably the top level of a bear and bull market. We've discussed a few things that you can do in both the bear and bull market. I'm pretty cash heavy at the moment. I've probably got 30%.
Bags.
Not a lot of cash. I've just percentage wise, I reckon I'm 30% in the market at the moment.
Wow. Well, I'm not that radical, but I'm the same. I'm probably like 30% cash, but it's more that whatever I'm getting paid now, I'm holding more and more of that out. I'm still transferring it to my trading account, so I can't spend it.
Yeah, nice. Good strategy.
It's sitting in cash. So that's something that, we don't give advice on this show because we're learning, and we've never lived through a bear market, but that wouldn't be the worst strategy, I think, if you wanted to just minimize your risk.
Yeah. Interestingly, you have it sitting in your trading account and not in an interest account.
Yeah, it's too easy to take it out of my interest account. It's just like, it's all in the same Commonwealth Bank app, so you can just transfer it out.
Interesting. Yeah, fair enough.
I need to get a better, infrastructure going there, I guess, but it's never a big enough concern for me. Like, I never have enough money in my interest account to really really benefit from it because
Yeah.
generally, if I've got money in there, I want to put it in the market rather than just leaving it in an interest earning account. But yeah, hopefully everyone can learn from my mistakes.
Did you buy anything in the latest correction?
No. I actually basically just worked through it. I checked the markets at work, but it happened on a Monday and then again on a Thursday. And
you mean you actually worked through it?
Yeah. Like I was actually busy with my day job and I didn't really get to enjoy it. What about you? Did you buy anything?
I didn't buy anything. It was a good learning for me because 2015 correction kind of came and went and I almost didn't really realize it was there. It happened. And then this one came and saw it happening, but then I was more focused on protecting my portfolio than actually taking advantage of buying the dip. And it would have been such a good thing to do because there's so many stocks that are on my watch list that if you look at their charts, had a serious dip and they're now back up to even higher than they were before the correction came. So it was a great buying opportunity, but I wish I had been more, conscious about, I wish I had a strategy in mind on how to deploy my cash, but that's the learning for next time.
Yeah, well, there will always be a next time. And speaking of being conscious and having a strategy, we may have gone over our 15-minute strategy. So we will say thanks for listening, everyone, and we'll catch you in a couple of days.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.